Welcome back to the deep dive. I have to be honest with you, today's topic has been keeping me up at night.
Oh, really? Keeping you up.
Yeah, seriously. We are tackling something that feels incredibly personal to all of us. Our money, our careers, our literal value in the marketplace.
Right, the stuff that stresses everyone out.
Exactly. But we are finding out from the research that it is actually governed by these cold, invisible structural laws. We are talking about the architecture of financial independence today.
It is a massive topic.
It is. But before we get into the nuts and bolts of it, I want to throw a premise at you that, frankly, when I first read it in the source stack, I thought it was complete nonsense.
Nonsense. That is a strong start. What was the premise?
Well, the premise is that how much you earn is an almost irrelevant metric compared to how you earn it.
Yeah.
And I looked at that and thought, come on. I mean, if I am making 50 grand a year and my neighbor is making 500 grand a year, you cannot tell me the how matters more than that extra zero. That extra zero changes your entire life.
Well, it changes your lifestyle, certainly. I mean, you buy a better car, go on nicer vacations, but it doesn't necessarily change your structural reality. And that is the uncomfortable truth we need to sit with today.
Okay, so let's stress test that right out of the gate. Let's take a surgeon, top of the food chain,
Oh,
right?
here, high status.
Making, say, $600,000 a year, drives the Porsche, has the huge house. Then you have, say, a factory worker or a barista making $40,000. On the surface, these two people are living on completely different planets.
Economically speaking, in terms of daily consumption, yes, they are. But structurally, let's look at what happens if they both stop showing up to work tomorrow.
Okay.
Maybe the surgeon breaks a hand skiing. Maybe the factory closes down. What happens to their income?
Well, for both of them, it goes to zero.
Instantly.
Instantly, yeah.
Exactly. And that is why, in the eyes of the economic framework we're looking at today, they are in the exact same boat. They are both trading their time for money.
But at completely different rates.
Yeah. Right. The surgeon is just selling their time at a much higher wholesale rate. But the underlying mechanism is identical. They are both what economists call labor dependent.
That is kind of depressing, actually.
It can be.
You spend 12 years in medical school and take on all that debt just to be a high-end hourly worker.
If you don't own the clinic or the hospital, yes. And that is the core distinction we are going to unpack today. It is the difference between the quantity of income, which is what we are all socialized to chase, and the quality or the source of that income.
So to really get to the bottom of this, we aren't just reading one self-help book and calling it a day. We have built a really weird, eclectic source stack for this deep dive.
It is a bit of a collision, isn't it?
It really is. We are smashing together some things that usually don't sit on the same bookshelf. We are starting with a popular classic, Robert Kiyosaki's Cash Flow Quadrant.
Right, which is a massive bestseller.
Massive. Now, I know Kiyosaki is a controversial figure, and we will absolutely get to that later. But his diagnostic tool is genuinely useful.
It provides a great visual vocabulary.
Exactly. But we aren't stopping there. We are stress testing his pop psychology against some serious academic heavyweights. We have Thomas Piketty's economic data on capital.
Basically, the unified theory of why rich people get richer.
Yes, exactly. And we have Gary Becker's human capital theory from the University of Chicago.
A Nobel laureate, no less.
Right. And then, to make sure we don't just get bogged down by the macroeconomic theory, we are layering in a modern counter-strategy from M.J. DeMarco's book, The Millionaire's Fast Lane.
Which effectively challenges the traditional save 10% and pray advice we all grew up with.
The mission today is to move beyond the motivational bumper stickers. You know, passive income is such a buzzword on social media right now. But I want to know, is it mathematically real?
Or is it just a scam to sell online courses?
Right. We want to build a scientifically grounded architecture for financial independence for you, the listener.
And my role here is basically to be the wet blanket.
The structural engineer.
Sure, let's go with structural engineer. I want to strip away the get-rich-quick mythology and look at the actual math, because when you look at the math of labor versus capital, it explains almost everything about wealth inequality, career stress, and why you feel like you are running on a treadmill.
So let's start with the map, the diagnostic tool. Kiyosaki calls it the cash flow quadrant. For everyone listening, I want you to grab a napkin or just visualize it in your head. Draw a cross in the middle of the page. You have 4 boxes.
It is a simple 2x2 matrix. On the left side of the vertical line, in the top box, you have the E. That stands for employee.
Okay.
And below that, in the bottom left, you have the S. That stands for self-employed.
Okay, E and S are on the left. Now across the line.
On the right side, Top box, you have the B, business owner, and bottom right, the holy grail for a lot of people, the I, investor.
4 letters. ESBI. This seems simple enough, almost too simple. But the magic isn't in the letters themselves. It is in that line down the middle. What is actually dividing the left side from the right side?
The dividing line is the mechanism of income generation. It is about the relationship between your effort and your reward. On the left side, the employee and the self-employed, the income is linear.
Meaning a direct exchange.
Yes, you put an hour in, you get a unit of currency out. It is a 1-to-1 ratio.
So if I work 0 hours, I get $0.
Correct. The income is fundamentally tied to your physical presence. On the right side, business owner and investor, the income is nonlinear. It is generated by a system, in the case of the business owner, or by capital, in the case of the investor.
So the money works for you.
Right. You might work 0 hours this week, but the checks still come in. The income has been disconnected from your time.
And the source material makes a really big point that this isn't a moral judgment. It is not saying employees are sheep and investors are wolves.
No, not at all. It is strictly a diagnostic tool. It is asking you to audit the plumbing of your financial life. If you walk out the door and turn off your phone for 6 months, does the money keep flowing?
But if the answer is no, you are on the left side.
Exactly. It does not matter if you are the CEO of a company or the janitor cleaning the floors. If you have to be there to get paid, you are on the left side.
You know, this gets me thinking about why we were all seemingly defaulted to that left side. I mean, growing up, nobody told me about the B or I quadrants. It was always go to school, get good grades, get a good job. That was the entire script. Why is the E quadrant so dominant in our culture?
This is where we need to zoom out and look at history. Because the employee concept is actually a surprisingly modern invention. If you go back 200 years, the E quadrant barely existed.
Wait, really? Who did all the work then?
Well, prior to the Industrial Revolution, most people were effectively in the S or B quadrants. If you were a blacksmith, a farmer, a cobbler, you owned your tools, you owned your output.
You sold your product directly to the village.
Exactly. You didn't have a boss in the sense of a middle manager doing your annual performance review. You had customers.
So we were basically a nation of freelancers.
Essentially, yes, we were autonomous. But then comes the Industrial Revolution. Suddenly, you have these massive factories being built, and they need consistency.
They can't have 1,000 freelancers showing up whenever they feel like it.
Right. They need standardized labor. They need reliability. So the concept of the job was engineered, and it was a very specific social contract.
What was the deal?
The deal was you give up your autonomy. You show up when the factory whistle blows. You do exactly what we tell you to do. You don't own the product you make, but in exchange, we give you stability.
And at the time, that was a pretty compelling offer.
It was incredibly compelling,
Really?
especially compared to the volatility of being a subsistence farmer where one bad harvest means your family starves. The job offered a steady paycheck, and eventually it offered pensions, health care, paid time off.
It was a massive trade. Freedom for security.
Exactly. And that trade became so normalized over the generations that we forgot it was even a trade. We just think that is what life is. You turn 18, you look for a job.
We built our entire education system to train people for the E quadrant. Sit in rows, follow instructions, move to the next room when the bell rings.
It is literal factory training.
Hey.
But here's the problem, and really why we are doing this deep dive now. That 150-year-old deal, it is breaking.
How so? The security part.
Yes, the security side of the bargain is evaporating. Pensions are mostly gone. Lifetime employment at one company is a myth. Wages have stagnated in real terms for decades.
So people are still giving up their autonomy. They're still showing up when the whistle blows, but they aren't getting the security in return.
Precisely. And that is why everyone is so anxious. We are paying the price of the E quadrant, but not getting the reward anymore. Understanding the other quadrants isn't just a get-rich scheme. It is becoming a survival strategy.
Now, before we move on to the traps of the left side, I want to touch on something Kiyosaki mentions that I found a bit, well, stereotypical. He talks about how different personalities gravitate toward different quadrants. Like, the employee craves security, the self-employed person is a control freak who wants to do everything themselves.
It sounds like a financial horoscope.
Right. I am a Virgo, so I must be an investor. Is there any truth to that? Or is it just pop psychology?
Well, this is where we brought in the academic rebuttal. We looked at a meta-analysis by Zhao and Seibert from 2006.
Yeah.
They studied the personality traits of entrepreneurs versus managers. And they did find actual differences.
They did.
Yes, entrepreneurs consistently score higher on openness to experience and risk tolerance.
So there is a personality type.
There is a correlation. But, and this is a massive distinction, Kiyosaki treats these traits as destiny. He says he is an E because he is naturally afraid. The research suggests these are largely adaptations,
Meaning you can learn to take risks.
meaning risk tolerance is like a muscle. Most successful business owners in the B quadrant started out as employees in the E quadrant. They weren't born fearless.
They had to learn it.
They learned the ropes, they built a safety net, they acquired skills, and then they took the leap. If you are listening to this and thinking, I am too anxious to start a business, the data says that isn't a permanent diagnosis. That is just your current state of training.
I really like that. It is not DNA, it is a skill set.
Yeah.
Okay, let's dig into the left side, the place where 90% of us live, the E and the S. We have touched on the history, but let's talk about the trap. Why does the source material called the E quadrant structurally vulnerable?
Think about the geometry of it. As an employee, you have a single source of income. You are 100% dependent on one relationship with one entity. In biology or engineering, a system with a single point of failure is considered a terrible design.
If that one cable snaps, the elevator falls.
Exactly. And the power dynamic is incredibly asymmetric. Your employer likely has hundreds, maybe thousands of employees. If they lose you, it is an annoyance. They post a job ad. If you lose them, it is a catastrophe for your household.
We saw this vividly during the COVID-19 pandemic. I mean, that was a huge wake-up call for millions of people.
It was a mass natural experiment in structural vulnerability. People who had safe jobs, who had played by all the rules for 20 years, suddenly found that their income could be turned off with a switch because of a macro event they had zero control over. The illusion of security was totally shattered.
But hold on a second. I have to push back here. Our experts stack isn't just anti-job, is it? Because that feels irresponsible to tell people. Most people need jobs to survive, and surely not all jobs are traps.
You are absolutely right to push back, and this is where we bring in Gary Becker and his human capital theory to correct Kiyosaki's harshness. Kiyosaki sometimes talks about a job like it is a prison sentence. Becker talks about a job like it is a university that actually pays you to attend.
Explain that. How is a job a university?
Becker argues that the primary value of the E quadrant, especially early in your career, isn't the salary at all. It is the human capital you acquire.
Skills, networks, reputation.
Exactly. Let's say you get a job at a top-tier tech company or a major consulting firm. You are essentially being paid to learn how to run a business. You are being paid to meet influential people. You are using their expensive software, their resources, their marketing budget to build your own toolkit.
So the trap isn't having a job. The trap is, what, staying too long?
The trap is staying in the job after the learning curve has flattened out. We define the rat race not as having a job, but as the state where you are no longer acquiring human capital and you are only there to service your debt or pay for your lifestyle.
You're just maintaining the status quo.
Right. That is when you are trapped. If you are learning, you are leveraging the E quadrant. If you are just coasting for the paycheck, the E quadrant is leveraging you.
That is a really powerful distinction. Use the job, don't let the job use you. Now let's talk about the S, the self-employed, the freelancer, the consultant, the local dentist. This is usually the dream, right? I am going to fire my boss and work for myself.
It is the dream of autonomy, but it comes with a very specific, very dangerous trap. Michael Gerber, in his book, The E-Myth Revisited, calls this the fatal assumption.
Which is what?
The assumption is that because you are highly skilled at the technical work, say you are an amazing baker, that you will naturally be good at running a business that does that technical work.
But those are totally different things.
Completely different skill sets. The skill of actually baking bread is maybe 1% of running a bakery. The other 99% is sourcing wholesale flour, hiring reliable staff, managing cash flow, doing local marketing, dealing with health inspectors.
So the baker quits his corporate job to be free, but he ends up working 80 hours a week doing things he hates just to keep the oven on.
He didn't buy freedom at all. He just bought a job.
He bought a job where the boss is an absolute maniac himself.
Yes. And here is the structural killer for the S quadrant. If that dentist or that baker goes on a 2-week vacation, do they get paid?
No. The drill stops, the oven turns off, the money stops.
That is the fragility. The income is still linearly tied to their time. The dependency has simply shifted from an external boss to the internal self. The source material calls this biologically fragile.
Because your body is the bottleneck.
You are betting your entire financial future on your own health and your ability to show up every single day. If you burn out or get sick, the revenue hits zero immediately.
So the S quadrant feels like freedom because no one is telling you what time to arrive, but structurally, it is still a trap.
You are the bottleneck. You have freedom of method, you can choose how to do the work, but you do not have freedom of time.
Okay, so that is the gloomy stuff on the left side. It's fragile. Let's cross the river. Let's go to the right side, the B and the I. This is where the magic happens, supposedly. Let's start with the B, the business owner. How is this fundamentally different from the self-employed guy we just talked about?
The definition of B in this framework isn't about legal status or having an LLC. It is about systems. The litmus test Kiyosaki gives is this. Can you leave your business for a year, completely disappear, no emails, no calls, and come back to find it more profitable than when you left?
If I left this deep dive for a year, I'm pretty sure I would come back to a dead feed and a very angry producer.
Then structurally, you are in the S quadrant, you own a job. The B quadrant is about building a machine that works without you. The classic analogy here is McDonald's.
Here we go. The golden arches.
Think about it. Does McDonald's hire the best chefs in the world?
Definitely not. They hired teenagers.
Exactly. And yet that teenager can deliver a product that tastes exactly the same in Tokyo, Paris, and New York. How is that possible? Because the system is the genius, not the person. The B quadrant is about solving problems with processes, not just throwing more people at it.
Process over person.
Yes. If your business relies on you being a unique genius, it cannot scale. If your business relies on a checklist that anyone with basic training can follow, you can replicate it 10,000 times. That scalability is the engine of the B quadrant.
So the ultimate goal of the business owner is to make yourself useless.
Ideally, yes, to make yourself obsolete from the daily operations. Because once you do that, you have liberated your time and you have created a standalone asset that can actually be sold to someone else.
Which leads us nicely to the final box, the investor, the I quadrant. This is the one everyone wants. Passive income.
The term passive income is pretty dangerous, though. It implies you just sit on a beach and do absolutely nothing. The source material refers to a fascinating study by Chambers, Spengers, and Steiner regarding long-term real estate returns. They looked at what it actually takes to get those supposedly passive returns.
And what did they find?
It is not passive. It is hidden labor.
What do you mean by hidden labor?
Finding the deal, vetting the tenant, negotiating with the bank, fixing the boiler at 2 a.m., managing the property manager. It is work.
So the whole dream of sipping Mai Tais while the checks magically roll in is just a lie.
It is an exaggeration of the reality. The I quadrant isn't no work. It is capital work. It is the work of asset allocation and management. But here is the key difference. The relationship is no longer linear.
Right.
You might put in 10 hours of work a month to manage a real estate portfolio that generates $500,000 a year. In the E quadrant, to get $500,000, you have to put in 3,000 hours of direct labor.
It is leverage.
It is the leverage. And this leads us to what is probably the most important question of this entire deep dive. Why? Why does the right side win so predictably? Is it just luck? Is it just that they work smarter? Or is there a literal law of physics at play here?
This is where we bring in the heavy artillery. Thomas Piketty, French economist, wrote a massive, thick doorstopper of a book called Capital in the 21st Century.
Yes.
And he basically boiled the entire history of modern capitalism down to 3 symbols. R is greater than G.
This is the formula that explains the modern world. It really is.
Break it down for us. What is the R and what is the G?
R stands for the return on capital. This is the average annual return you get from simply owning assets. Stocks, real estate, bonds, private equity. Historically, over centuries of data, this averages about 4 to 5% a year.
Okay, so that is a money-making money, 4 to 5%. And what is G?
G stands for economic growth, which serves as a highly accurate proxy for the growth of wages and labor income. Historically, this averages about 1 to 1.5% a year.
So capital, the R, grows at 5%, and wages, the G, grow at 1%.
And that gap, that seemingly small difference between 5% and 1%, is the engine of global inequality. It means that if you own assets, your wealth is naturally automatically pulling away from the people who only own their labor.
Let's put some flesh on that bone. Give me a concrete example so we can really see it.
Okay, let's look at 2 hypothetical people. Meet Alice and Bob. Bob is a superstar employee. He works incredibly hard, stays late, and gets a 2% raise every single year, which beats the average G. He saves a little bit, but mostly he lives on his salary.
Okay, Bob is grinding. What about Alice?
Alice does not work. She inherited a portfolio of assets worth $1 million. She gets a 5% return on that capital every year.
Okay, I see where this is going.
In year one, Bob gets his salary. Alice gets $50,000 without lifting a single finger. But here is the kicker, the compounding effect. Alice reinvests that $50,000. Now she has $1.05 million. Next year, she earns 5% on that larger number.
It snowballs.
It compounds. Bob's raise, it barely keeps up with inflation. He is working harder just to buy the same groceries.
So Bob is running on a treadmill that is set to 1 mile per hour, and Alice is on a rocket ship that is constantly accelerating.
Exactly. Over 20 or 30 years, the gap becomes an ocean. Alice's wealth doubles, triples, quadruples, purely through the mechanism of compounding capital. Bob's wealth stays relatively flat because his G is capped. He cannot physically work 25 hours a day. He hits a biological ceiling. Capital has no ceiling.
That is the structural reality. R eats G for breakfast.
It does, and we have to be clear, this isn't a conspiracy, it is just math, it is how the system functions. But to make matters worse for the left side of the quadrant, the government adds a layer to this that makes it even more stark.
You are talking about the tax code.
The tax code. In almost every jurisdiction, the US, the UK, across Europe, income derived from labor, salaries, is taxed at the absolute highest rates. Income derived from capital, like capital gains and dividends, is taxed at lower rates, in some cases significantly lower.
Now that always feels deeply unfair to people. Why does the billionaire pay a lower effective tax rate than his secretary? Warren Buffett famously pointed that out.
It feels unfair, morally, without a doubt. But we are looking at it structurally. We need to understand the structural incentive. Governments are terrified of two main things: high unemployment and a stagnant economy. And who solves those two specific problems for the government?
Business owners and investors.
Right. They are the ones providing the capital that builds the factories, funds the research, and starts the companies that hire people. So the government basically says, if you take the personal risk to start a business or invest capital, we will reward you with a tax break to incentivize that behavior.
And if you are an employee?
If you are an employee, you aren't taking that financial risk, so you pay full price on your taxes.
So the tax code is basically a giant incentives chart. The government is pointing a huge neon arrow and saying, please go to the right side of the quadrant.
Exactly. They are practically begging you to move to the B and I quadrants. But, and here's the tragedy, most of us simply don't do it.
Why not? If the math is so overwhelmingly clear, R is greater than G, and the rules are completely rigged in favor of the B and I, why are we all still clinging to the E quadrant? This brings us to the psychology section of our research, the brain bugs.
This is where the math meets the monkey brain. We like to think we are rational calculators, but we aren't. We are emotional survival machines. And the biggest psychological hurdle keeping us on the left side is loss aversion.
From Kahneman and Tversky. Prospect theory.
Yes, the Nobel Prize-winning research. The finding is that human beings feel the pain of a loss about twice as intensely as we feel the pleasure of an equivalent game.
Give me an example of that.
Losing $1,000 ruins your entire week. You can't stop thinking about it. Finding $1,000 on the street makes you incredibly happy, but only for an hour or two.
How does that apply to our careers and the quadrants?
Well, the E quadrant offers certainty. A steady, predictable paycheck every 2 weeks. The B quadrant offers possibility. You might make millions, but you might also lose your life savings. Because we fundamentally fear the loss twice as much as we value the potential gain, the safe salary feels incredibly heavy in our minds.
We cling to the mediocre certainty rather than risking it for the spectacular possibility.
We are wired by evolution to stay in the cave where it's safe, rather than go out and hunt the mammoth where we might get crushed.
And that makes total sense. We are fighting our own biology.
Precisely. And then, if that wasn't enough, you add in present bias, or what economists call hyperbolic discounting, which is a fancy academic way of saying we are terrible at valuing the future.
The I will start my diet tomorrow problem.
Exactly. We look at the cost of starting a business today, the late nights, the stress, the potential embarrassment if it fails, and that pain feels massive and immediate. But we look at the benefit, financial freedom, and that is 5 or 10 years away.
It is too abstract.
Right. Our brains naturally discount that future reward to almost zero. So the concrete pain of today outweighs the abstract pleasure of tomorrow, and we end up doing nothing.
We literally procrastinate our own freedom.
We do. And we also suffer from the planning fallacy. We consistently, systematically underestimate how hard things will be and how long they will take. We think, oh, I will just build this app in a weekend.
And 6 months later,
You are still debugging the login screen. And that massive gap between our initial expectation and the harsh reality causes people to quit. They hit what Seth Godin calls the dip, the hard part of any new venture, and they retreat right back to the safety of the E quadrant.
but the source material does suggest a hack for this, right?
Mhm.
To get around these brain bugs, the goal gradient effect.
Yes. This is a fascinating piece of behavioral psychology. Research shows that human motivation isn't a constant flat line. It accelerates as you perceive you are getting closer to the goal.
Like a coffee loyalty card.
Perfect example. When you have one stamp on a 10-stamp card, you aren't that motivated. But when you have 8 stamps and you only need 2 more for a free coffee, you suddenly buy those last 2 coffees really fast. You go out of your way to go to that specific cafe.
Because you can smell the finish line.
Exactly. So how do you hack this for wealth building? Don't set a massive distant goal of financial freedom in 10 years. That is too far away. You will lose motivation and quit.
So what should you do instead?
Set a micro goal. I want to make my first $100 outside of my job this month. Or I want to replace my monthly car payment with side hustle income by December.
You move the finish line closer to trick your brain.
Exactly. Create artificial finish lines that are close enough to trigger that goal gradient acceleration. Hack your own dopamine system to keep moving toward the right side of the quadrant.
I love that. Use the biology against itself. Okay, so we have diagnosed the structural problem and we have analyzed the psychology holding us back. Now I want to shift gears and talk about speed. Because there is a very common piece of financial advice out there that says, stay in the E quadrant, just be disciplined, save 10% of your paycheck, put it in a low-cost index fund, and in 40 years, you will be rich.
The slow lane.
Right. MJ DeMarco calls this the slow lane in his book, and he absolutely hates it. He basically argues that this traditional advice is a scam. Why is he so aggressive about this?
DeMarco is the aggressive, no-nonsense counterpoint to the whole skip-your-morning latte crowd. His argument is essentially philosophical. He asks, why would you trade 5 days of work for 2 days of freedom the weekend for 40 years of your prime life, just so you can be rich when you are too old to actually enjoy it?
Rich in a wheelchair, as some people call it.
Right. He argues that wealth needs to be disconnected from time now, while you have the energy, not in 40 years. And to do that, you need to understand the math of the liquidity event.
Okay, this is probably the most technical part of our deep dive today, but I think it is the absolute most important concept to grasp. What exactly is a liquidity event, and why is it the key to what DeMarco calls the fast lane?
A liquidity event is simply when you sell an asset, usually a business, to someone else. Most people in the E and S quadrants focus entirely on cash flow, their monthly profit or salary, but the genuinely wealthy focus on equity value. Let's do some math to show why.
Let's do it. Walk us through it.
Let's say you have a good corporate job paying $100,000 a year. To double your money to get to $200,000, you have to work twice as hard, or wait 10 years for compounding raises, or get promoted twice. It is a massive grind.
Right. Very linear.
Now, let's say you build a business instead. Say a software as a service company or a niche e-commerce brand. And let's say that business, after all expenses, makes $100,000 in net profit, the exact same as your salary.
Okay, so I am taking home the same amount of money to pay my mortgage. What is the actual difference?
The difference is that the business is an independent asset. And businesses are valued by buyers based on a multiple of their annual profit. In the software world, for example, a growing business might easily sell for a 5 times multiple or even a 10 times multiple of earnings.
Meaning, if I decide to sell it, I don't just get this year's profit.
You get 5 to 10 years of profit upfront, paid in a single check. If your business makes $100,000 profit and you sell it for a 6 times multiple, you get a check for $600,000 today.
You just time traveled.
Exactly. That is the fast lane. You just compress 6 years of grinding work into one single transaction. And let's scale it up. If you can grow that annual profit to $1 million and sell for a 6 times multiple.
That is $6 million. That is literally a lifetime of E-quadrant wages generated in one afternoon at a lawyer's office.
That is exactly how the super wealthy are made. Not by diligently saving 10% of a salary and clipping coupons, but by building a system, increasing its intrinsic value, and then exiting via a liquidity event. It is literally the only mathematical way to beat the constraints of time.
But DeMarco warns us, and this is crucial, you can't just start a neighborhood lemonade stand or a basic blog and expect a 10 times multiple from a buyer.
No, absolutely not. He has his rules, what he calls commandments, for a business to actually qualify for the fast lane. The two biggest ones we need to understand are entry and scale.
Let's start with entry.
The commandment of entry states very simply, if it is easy to do, it is not worth doing.
Meaning, if I can start this business in a weekend by filling out an online form.
Then so can everyone else in the world. And that flood of competition will eventually drive your profit margins down to absolute zero. You need barriers to entry. You need to solve a genuinely hard problem, write complex code, secure patents, build a difficult supply chain.
Hard as the moat.
Yeah.
And what about scale?
The commandment of scale states, to make millions, you must impact millions. If you are a local massage therapist, you can only physically help one person at a time. Your income is mathematically capped by the hours in a day.
Right, you hit a ceiling.
But if you invent a revolutionary new massage chair device, you can manufacture it and sell it to 1 million people worldwide.
It goes right back to the fundamental difference between a job and an asset. A job serves one person, your boss. An asset serves the entire market.
Correct. The magnitude of the problem you solve dictates the magnitude of the wealth you generate.
Now, DeMarco wrote his book quite a while ago, and the world has changed rapidly since then. We have the modern internet, artificial intelligence, remote work. How does this whole framework fit into what economists call the intangible economy?
This is the necessary modern update to the theory. We reference the book Capitalism Without Capital by Haskell and Westlake. They argue convincingly that the very nature of what constitutes an asset has fundamentally changed.
Yes.
Well, it used to be physical things, factories, delivery trucks, heavy machinery, land. Now, the most valuable assets on Earth are intangible. It is code, algorithms, brand equity, data networks.
And this creates a really weird hybrid situation for the quadrants, doesn't it?
Yeah.
Take a modern software developer who writes an iPhone app by themselves in their basement. They look exactly like an S, a self-employed person. They're working completely alone.
But they are actually building an I-quadrant asset. This is the absolute magic of the digital age. It is a concept called zero marginal cost.
Explain zero marginal cost for us.
Think about a traditional physical business. If Ford wants to sell one additional car, they have to buy more steel, more rubber, more glass, and pay a worker to assemble it. It costs real money to make the second unit.
Right.
If a software developer wants to sell one more copy of their app or a creator wants to sell one more copy of an ebook, what does it cost them?
Nothing. It is just copy and paste.
Virtually zero. That means the profit margins on digital assets are astronomical compared to physical businesses. This allows for wealth accumulation at a speed that even the Industrial Revolution barons couldn't possibly dream of. You can literally scale a product to 1 million users with a team of 5 people.
So the fast lane has effectively gotten much faster.
Much faster and much more accessible if you have the technical skills. But we have to issue a warning here because there is a massive trap in the modern digital economy too. The gig economy.
Ah, yes. Uber, DoorDash, TaskRabbit.
We call this platform capitalism. On the surface, it is marketed as the ultimate freedom. An Uber driver looks like they are in the S quadrant. They have no manager, they choose their own hours, they use their own car. But structurally, what are they really?
Well, they don't set the price of the ride. They don't own the customer list.
Yeah.
They have no control over the algorithm that feeds them work.
Exactly. Economists call this dependent self-employment. They have absorbed all the insecurity and risk of the entrepreneur, like no guaranteed pay and paying their own expenses, with none of the control or upside of the business owner. It is structurally the worst of both worlds.
So if you are driving for Uber, you are definitely not building an asset. You are just renting out your depreciating car and your time. You are structurally stuck.
You are feeding someone else's asset. You are the raw labor fuel for Uber's massive B quadrant machine. You are their G while they collect the R.
Ouch. That is a really harsh reality check. And speaking of reality checks, we need to do one more major one before we wrap up today, because we have spent an hour making this sound, well, logical. Almost easy. Just build an asset. Just exit for a 6 times multiple. But if it were genuinely that easy, everyone would be a millionaire.
Right. We have to talk about survivorship bias.
The silent graveyard of failed ideas.
Exactly. We look at Elon Musk or the guy who sold his app to Google for $50 million and we say, I can do that. We don't see the 10,000 other people who tried the exact same thing, worked just as hard, and went totally bankrupt. The source material cites Scott Shane's data on this. Half of all new businesses fail completely within 5 years.
And this stat from the research really blew my mind. The median entrepreneur actually earns less than the median employee.
Yes, if you take the statistical average, it looks high because billionaires like Jeff Bezos drag the average way up. But the median, the typical guy right in the middle, is often grinding 80 hours a week for less than minimum wage when you factor in the hours. The risk is very real. The E quadrant has a low ceiling, but it has a high floor. The B quadrant has an infinite ceiling, but the floor is literal lava.
And we also have to acknowledge what researchers call the starting line problem. It is really easy to say bootstrap a business, but it is incredibly hard to do that if you can't pay your rent next week.
Structural barriers are very real. We looked at Raj Chetty's research on intergenerational mobility. The data shows that your childhood zip code and your parents' income are massive, unavoidable predictors of your eventual success. It takes money to make money. The I quadrant is completely closed to you if you have zero capital to invest. The B quadrant is incredibly hard to survive if you have no financial runway to get through the lean first years.
So we shouldn't be naive about this. Moving to the right side isn't just about having the right mindset or reading the right book. It is about resources.
It is about both. Having the resources makes it infinitely easier, but understanding the map helps you navigate, even if you are starting from a structural disadvantage. You have to know the rules of the game to have any chance of winning it.
And lastly, a quick word on the architect of the quadrant himself, Robert Kiyosaki. The source material we reviewed is actually pretty brutal on him as an individual.
Yes, there is the corporate bankruptcy, the involvement with multi-level marketing schemes, and some very questionable specific financial advice over the years.
So how do we reconcile that with using his framework today?
We have to firmly separate the message from the messenger. Kiyosaki, the financial guru, is, well, highly problematic, but the cash flow quadrant, the diagnostic tool itself, it is structurally very sound. It perfectly aligns with Piketty's macroeconomics. It aligns with how the global tax code is written, and it aligns with the mathematical reality of compounding capital.
So the takeaway is, use the map he drew, but maybe don't join his cult.
Exactly. Take the framework, apply it to your life, but leave the hype and the seminars behind.
All right, we have covered a massive amount of ground today. We have gone from 19th century factory workers to 21st century app developers. We have done the sobering math on R is greater than G. We have psychoanalyzed our deep evolutionary fear of leaving a steady job. If we try to boil this all down for the listener, what is the ultimate synthesis of all these sources?
I think the synthesis is a unified toolkit for your career. First, use Kiyosaki for the diagnosis. Look at your life and ask, where is my money actually coming from? Is it time-bound or is it asset-bound?
Okay, diagnosis first.
Second, use Gary Becker to validate your current job. Ask yourself, am I learning? Am I aggressively building human capital? If you are, stay. If not, you are rotting in the rat race and you need an exit plan.
Great.
Third, use MJ DeMarco for your exit strategy. Ask, am I building something truly scalable? Am I aiming for a liquidity event? Or am I just building myself another job? And finally, use Thomas Piketty to always remember the fundamental law of gravity in capitalism. Capital inevitably beats labor over time.
It is not necessarily about choosing one single path forever. It is about deeply understanding the physics of money so you can stop fighting that gravity.
Right. The overarching goal over a lifetime should be to slowly, methodically shift the heavy weight of your financial survival from your own back, your labor, to the back of your assets, your capital.
So as we wrap up, I want to leave you, the listener, with a final, somewhat provocative thought. We talked a lot today about solving problems for the market.
It is the core of wealth creation.
But the question you really need to sit down and ask yourself is this. Are you solving problems with your time, or are you building assets that solve problems without you?
That is the ultimate test.
Think about the highly paid surgeon again. She solves a critical problem with her own hands every single day. But if she stops moving her hands, the problem isn't solved, and the income vanishes.
But the person who builds the hospital,
Or patents the medical device she uses. That person solves the problem structurally.
and the answer to that question, time versus structure, determines exactly which side of the macroeconomic equation you fall on. Are you the labor, the G, constantly struggling to keep up with inflation, or are you the capital, the R, continuously pulling ahead?
It is definitely something to think about the next time you look at that pay stub. Don't just check the dollar amount. Check the source.
Check the plumbing.
Thanks for diving duck with us today. We will see you on the next one.
Goodbye.